If you are within 5 years of retirement right now, I need you to stop everything and watch this video to the end. Because 5 new rules just changed in 2026. And if you miss even one of them, you could be forced to work 5 more years than you planned. Not because you want to. Because you did not know what changed in time to do anything about it. I am going to walk you through every single rule that changed for retirement in 2026. In plain English. With real numbers. And exactly what you need to do right now, before it is too late. Let us start with the rule that is catching the most people completely off guard. The full retirement age rule. The age at which you reach full retirement age has officially been set at 67 for anyone born in 1960 or later, starting January 1, 2026. This change has been building for decades under a law Congress passed in 1983, but 2026 is the year it fully locks in. This means if you were planning to retire at 65 and collect your full Social Security benefit, that plan is now wrong. Retiring at 65 in 2026 means claiming benefits to full years early, and claiming early has a permanent price. If you claim Social Security retirement benefits before reaching full retirement age and continue to work, your payments may be temporarily reduced. If you will reach full retirement age in a future year, the 2026 earnings limit is $24,480. Every dollar you earn above that limit costs you $1 in withheld benefits for every $2 earned over the limit. So here is the real-world math on what missing this rule costs you. If you retire at 62, the earliest possible age, your benefit is permanently reduced by up to 30% compared to waiting until 67. On a $2,000 per month benefit, that is $600 less every single month. Forever. Over a 20-year retirement, that is $144,000 you leave on the table, simply because you did not know the full retirement age changed. But here is the flip side of that same rule that almost nobody is talking about. Once you hit full retirement age, the earnings test goes away completely. You receive the full monthly payment you are eligible for with no deduction for work income, and the Social Security Administration recalculates your benefit amount to make up for any past withholding. This means if you kept working past retirement age and had benefits withheld, you get that money back in the form of a permanently higher monthly benefit. The system is not stealing from you. It is deferring your payment until you stop working, then giving it back. Now rule number 2. And this one directly affects how much money you can legally protect from taxes before you retire. The maximum 401k contribution has increased to $24,500 in 2026. For workers age 50 and older, the standard catch-up contribution is $8,000, bringing the total potential deferral to $32,500. And IRA limits have also risen to $7,500 plus a $1,100 catch-up, allowing older savers to contribute up to $8,600. If you are within 5 years of retirement and you are not maxing every single one of these limits, you are leaving tax-protected growth on the table every year you wait. At a 6% annual return, an extra $8,000 per year in catch-up contributions over 5 years grows to approximately $45,000 by the time you retire. That is $45,000 that your employer, your investment returns, and the tax code are helping you build, if you know the rule and use it. Right here, If Light Finance is giving you the retirement information that most people only find out about when it is too late. Hit that like button right now and subscribe. Hit the bell notification so you never miss a video. Because rule number 3 is the one that could add 5 more years to your working life if you miss it. And I am going to show you exactly how to use it in your favor instead. Subscribe now and let us keep going. Rule number 3. The Super Catch-Up Contribution. And this one is brand new in 2026. If you are between 60 and 63 in 2026, you can make a Super Catch-Up Contribution of $11,250 to your 401k. This means a 62-year-old worker maximizing their retirement savings can funnel a massive $35,750 into their 401k this year alone. Once you reach age 64, the limit reverts to the standard age 50 plus catch-up amount, $35,750, in a single year, in a single account. Tax deferred. If you are between 60 and 63 right now, this is the most powerful retirement savings window that has ever existed for Americans your age. And it only lasts 4 years. The seniors who use it will retire on schedule. The ones who miss it will keep working because their nest egg is not big enough. Rule number 4 directly affects what you pay for healthcare in retirement, and it is the rule that is quietly destroying the budgets of seniors who did not plan for it. Medicare Part B premiums went up nearly 10% in 2026, rising from $185 in 2025 to $202.90. The annual deductible for Part B is also increasing from $257 to $283. And the Part A hospital deductible is rising from $1,676 to $1,736, nearly 10% in a single year. These increases might seem incremental, but over time they can meaningfully affect retirement budgets, especially when combined with other out-of-pocket healthcare expenses. Medicare Part B premiums are now about 66% higher than they were a decade ago. Here is why this forces people to work longer. Most retirement income projections are built on fixed expense assumptions. A married couple that built their retirement budget, assuming $370 per month for Medicare Part B, $185 per person, now needs $405.80 per month. That is $35.80 more every single month, $429.60 more every year. Multiplied by a 20-year retirement, that is $8,592 that your plan did not account for. If you plan to retire before age 65, managing taxable income is no longer just a tax strategy. It is a healthcare strategy too. Your income level in the years before Medicare enrollment directly determines your Part B premium. Because selling your home before retirement can kick up Medicare premiums later. This is one of the most overlooked retirement traps in America right now. People sell a home, realize a large capital gain, and then discover 2 years later that their Medicare premium has jumped dramatically, because the SSA looks at income from 2 years prior to set your premium. Rule number 5. The new senior deduction that could cut your retirement tax bill by thousands, but only if you know about it before you file. For tax years 2025 through 2028, taxpayers who are age 65 or older may be eligible to claim an additional $6,000 deduction per person, or $12,000 if married filing jointly and both spouses are eligible. It is available to eligible taxpayers who claim the standard deduction or itemize. The deduction phases out for taxpayers with modified adjusted gross income over $75,000 for single filers and $150,000 for joint filers. $6,000 per person, $12,000 for a married couple, on top of everything you were already entitled to. And here is why this rule directly connects to whether you have to work 5 more years or not. Convert traditional IRA funds to a Roth IRA before claiming Social Security. Roth withdrawals do not count toward combined income, reducing taxable income during retirement and helping avoid pushing Social Security benefits into taxable thresholds. Use Roth withdrawals during high-income years if you already have Roth savings. Doing so may help keep adjusted gross income lower and reduce or eliminate Social Security taxation. The new $6,000 deduction creates a window, from now through 2028, to do Roth conversions at effectively zero federal tax for many moderate-income seniors. Converting pre-tax IRA money to Roth now, while the new deduction shields your income, means future withdrawals in retirement come out completely tax-free. The seniors who use this window will have dramatically lower tax bills in retirement. The ones who miss it will pay unnecessary taxes every year they are retired, taxes that force them to withdraw more from their accounts, which accelerates the depletion of their savings, which forces them to either cut spending or go back to work. These 5 rules work together. Full retirement age at 67 means claiming early costs you permanently. Higher 401k limits mean you can save more now if you act. The super catch-up window for ages 60 through 63 is the most powerful savings opportunity in a generation. Medicare premium increases mean your healthcare budget must be revised upward right now. And the new senior deduction means you have a limited time window through 2028 to position your accounts for the lowest possible tax burden in retirement. Whether you are still working or already retired, staying on top of these 2026 retirement rule changes can help you make better decisions now and avoid surprises later. The seniors who know these 5 rules and act on them in the next 30 to 60 days will retire on schedule, or even earlier than planned. The ones who miss them will not understand why their plan stopped working. They will look at their account balance in 3 years and realize they need to keep working. Not because they wanted to. Because 5 rules changed in 2026 and nobody told them in time. Drop a comment below right now and tell me, which one of these 5 rules surprised you most? Was it the full retirement age change? The super catch-up contribution? The Medicare premium increase? Because your answer tells me exactly what content this community needs next. And share this video right now with someone who is within 5 years of retirement, because this information is time sensitive and the people who see it in time are the ones who get to retire when they planned.